Welcome to this new episode of Your Next Trade. Episode number 16, we're going to be looking at more surprises needed. Indeed, the market has been trading in a range. I'm talking stocks with the S&P, the Nasdaq, and it feels very much like to have the new or the next move on the way up or the way down, we will need more surprises. For this video, for today, I'm going to be adding a section because I asked on the community, on the Discord community, if people wanted for me from time to time to be discussing some subject. So as you're going to see later, I'm going to be doing a 2 to 5 minutes quick discussion about the NFIB. So as always, let's start with the year-to-date asset performances and how the different assets have been behaving. If we look at stocks for the year, if we look at the S&P up 3.5%, the Nasdaq 6.4%, what is interesting is we can see that Europe is still the same, outperforming the US. So that has been the case for the last 3 months, where a lot of investors have been putting more money at work, not in the US and more in Europe, in Asia, in emerging markets. So non-US has been outperforming the US. If you look at the currency now, dollar has been following the trend that was ongoing from October onwards, which is the weakening of the US dollar. So the US dollar is roughly down 1 to 2% versus most currencies from the start of the year. For the crypto guys who had a really bad year last year, Ethereum, crypto, Bitcoin up 35%. I'm not involved, but it's always interesting to be looking at how the different assets, even if there's a question about the crypto as an asset class. And finally, looking at the commodities, gold up 5%. WTI flattish, so trading around the $80 level, and that has been the case for 2 to 3 months, trading between 73 and 85. And at the other end of the spectrum, we get natural gas, both in the US and in Europe, that has been quite down year to date. So week to date asset performances, not much happening for the stocks. Equities, we are down 0.7% and small up on the Nasdaq. The picture is a bit false if you look at the big move that we had yesterday. So as of Thursday, the picture will have been stocks down 2 to 3% in the US. But as we're going to see later, we had a good move yesterday in the US. Not much happening in the currency world. Bitcoin doing very well, so had a big rally on Friday. So what is really happening is the market is consolidating, waiting for more news, positive news or negative news, more surprises to happen for taking a direction. So based on that, if we look at the year-to-date industry's performance, this is more or less the same picture as last week, where the industries that are underperforming year-to-date are the defensive ones. We are talking consumer staples, utilities, healthcare, US dollar, so risk on. And the ones that are really outperforming the market are the beta one, the airlines, the online retail. We get semiconductors, transportation. So a lot of reopening of the reopening, even the economy has been reopening quite some time ago in the US, but we are seeing that airlines are doing quite well. So there is a lot of hope of the US consumer going back on force, which is a bit of a question mark looking at the retail sales that we had this week. So the week to date industries performances, as you can see, mostly down for the week. So that's interesting versus a market that was slightly down. So outperformers, internet, software, expectations of many companies coming with their earnings over the next 2 weeks. So expectations, and if you look at the Microsoft yesterday, Apple, that was Google as well. So the FANG did very well yesterday on Friday, really outperformed the market. Whereas at the other end of the spectrum, we had the industry that did very well as of start of this month, and there's a bit of reversion to the mean. So that is very true for XLI industrial, down 3 to 4% for the week. So a bit of reversion of performances before versus what we've seen before. And that's very true as well. If you look at the industries, sectors, factors that did well yesterday, that was the most shorted stocks. So a lot of risk on, at least on the week. Year-to-date sector performances here, I'm looking at the 11 sectors of the S&P plus the S&P. So the picture is very interesting for this week. You can see that the sectors that have been underperforming: industrials, utilities, and consumer staples. So we have both some defensive with utilities, consumer staples, and as well industrials, which tells you, again, reversion to the mean. I strongly advise you to look at XLI versus the SPY and the stronger performance over the last 3 months. And as well, question mark of based on the industrial production numbers that we have and the ISM, in the ISM manufacturing that we had 2 weeks ago, question mark of how the US economy for the manufacturing is doing. Rates, looking at the 10 years, looking at the 2 years, this is not the whole yield curve, but that's to give us a bit of feeling. So now we are staying at 3.48% on the US 10 years. Not much change on the week to date. We are waiting for the Fed. So the Fed is expecting, we're having the FOMC at the end of this month, start of next month. So FOMC coming on Wednesday the 1st of February. Expectations these days are for a 25 bips rate hike. So this is what is mostly priced by the market. If you look at the 10 versus the 2, not much of a steepening so far of the yield curve. We are at minus 0.69, so 69 bips negative. So and historically, that is a really good indicator that recession in the US will be coming. Now looking at the euro dollar and what are the peak rates, when will the Fed will be changing course. Story is more or less the same. It's the terminal rate is going to be between March and June of this year. More importantly, as I just said, FOMC expectations are for a 25 bips rate hike in February, and it feels very much that this is going to be the end of this rate curve, hiking. Maybe another 25 bips, but we are getting closer to the end. And if you look at the week-on-week, not much of a change. So far, if you look at all the asset classes, if you look at rates, if you look at Como, if you look at FX, if you look at stocks, we have been trading in ranges. So if you are on Twitter, there's going to be a lot of noise. People will account with 50,000 followers and more telling you should be selling, you should be buying. And when we're going to be looking at technical analysis, there are important levels. But so far, we are really making noise, and it's a bit of a shop ping pong between the 3,900, 4,200 on the 4,000, on the S&P, not moving much more than that. And the market is really looking for new content, new surprises. And so far, we haven't that much. So looking at the VIX volatility, roughly 20% on the VIX for the implied volatility 1 month. This is over the last 12 months pretty low. This is a level that is pretty low. Again, what the market has been pricing a lot over the last 4 to 6 weeks is a recession coming, maybe, but more importantly, a soft landing. So there was some scare until September that it will be a hard landing. It feels very much like we're gonna have a recession maybe later. So instead of having it around March, it might be in H2 of this year. There are some indicators that are telling you this is a soft landing, and some other indicators that it will be a hard landing. So for the time being, we are trading range. The VIX futures term structure is a normal one. So now I would like to discuss the NFIB. So the NFIB is a good leading indicator, and as well is a good way of understanding the US economy. So as I said before, in the Discord community, I've been asking people, what they wanted for me to discuss, and someone came with the NFIB. So the NFIB stands for the National Federation Independent Business. So it's a monthly survey, very helpful, that is conducted by the NFIB. NFIB, and it's typically for companies that have employing around 10 people and are having revenues around $500,000 every year. The good thing about this index, this indicator, is made of 10 seasonal adjusted components. So those are the ones, the 1, 2, and up to 10. So we are looking at employment, we are looking at inventories, we are looking at if we are expecting the economy to improve. And if you go into their website, which is here, you're going to have a very well detailed 33 components. And those different components will tell you a lot about the different themes of the economy. We are talking what is the outlook at 3 months, what the outlook at 6 months. Are they expecting to hire new employees? Are they struggling to find good employees? Do they see inflation? Are they concerned about earnings? Are they concerned about revenues? So it's a really, really good indicator. Again, 33 indicators, that gives you a lot to do. It's a good pile of information on business confidence, hiring, inflation, and capital expenditure plans. So the good thing about this indicator, it was created in 1974, so almost 50 years ago. So you're going to have a long history, you're going to have different economic cycles, and you can really go through those different numbers and through those different cycles to understand historically how things have been playing out. So here, one of the interesting fact about the NFIB is construction and retail make 45% of the NFIB. So what I put below here is the optimism index year on year versus the ISM. So as you can see, there was a strong correlation until 2016, 2017. And the last few years, the correlation between the ISM and the optimism index year on year has been coming on the way down. So there is a bit of divergence in the US between the big companies and the small companies. You need to take into account that for the small companies, this is a really good indicator actually for the US economy, because if you get a company that's got 10 people and $500,000 revenues, that is very often companies that will be doing their sales in the US. So it's if you want to be having a more in-depth understanding of how the US are working, and I'm not talking S&P 500 companies that are mostly, or some of them, exporting, this is a good indicator. If you look at the NFIB versus the conference board, you can see that recently there has been a divergence between the two, where NFIB has been on the way down, whereas the consumer confidence has been more or less staying at the same level. So some divergences over the last few months. Again, very good, both leading indicator, not as good as the ISM, unfortunately, but good leading indicator because it's going to give you the picture at 3 to 6 months, and it's going to give you a lot of detail of where is inflation, where is the business confidence, capital expenditures, what are the margins. So 33 different components. I strongly advise you to go on that website and putting everything on an Excel spreadsheet. As always, I'm going to be starting with the S&P futures. So S&P futures, everyone who is following the market knows that there is this downtrend. So far, market has been bouncing on this downtrend. So rejection after rejection, both on this downtrend and the 200 moving average. It feels to me, again, same story, as I said over the last 2 to 3 weeks, that the market is really keen on challenging this level. So I won't be surprised to see a bit of a short squeeze and actually a bull trap. And then fundamentally, I want to believe that we will have to retest at least the 3600. If you look at the NASDAQ, actually the picture is exactly the same. So we are challenging some important levels. So if you get some alerts, all those alerts will be triggered at the same time, both on the S&P and the NASDAQ. So don't think that you're having different position if you get the NASDAQ versus the S&P. I don't think that is the case. The Russell, similar, very important, not very important level, but some level, some resistance. Emerging market on the way up. As we said over the last couple of weeks, China reopening. China is making 50 to 60% of EM. A lot of money coming. With China reopening, a lot of hopes. We got the Chinese New Year, so Happy New Year for the Chinese viewers and for the others. If we look at the Stock 600, SXXP, Actually, I've been putting a bit of a short Europe from the start of this week because I think the outperformance is way too much, and as always with investors, I think there is a bit of too much and a hoo-ha phase. So Europe earnings season is starting to kick in. CL1 for WTI, so we are the top of the range, as I've been saying, the range that we started 6 weeks ago between these 82 and 70. I don't have a clear view on this one between the world is reopening and actually a recession. So I'm not going to comment that much. Euro dollar consolidating, similar picture. Dollar yen, similar picture, consolidating, but feels very much like the trend is still the same. So the trend is very much this way. So far, there is a lot of talk. So there was some expectation on Wednesday that the Bank of Japan will do more. They didn't do much. Coming into the earnings season, so two stocks that I want to flag because I think there is something in that I can spot in the technical analysis, which is Microsoft coming with their earnings. So Microsoft is on Tuesday. So Tuesday, the trend, downtrend, as long as you are in this downtrend, this is the way to play it. So you can be using the 260 level or the 200. So you can see that the range is pretty wide. We are talking 30%. Another one that I managed to find a bit of technical analysis and some support and resistance. And always with technical analysis, be careful. I always, when I do the mentoring, I call that a dodgy technical analysis. So this is 3M, so this is the downtrend as well. If it breaks this level, then obviously you could see some upside. So Excel spreadsheet now. Going for this week, so what happened this week? We had the PPI for inflation. We got the retail sales. So PPI first was a bit better, so that helped the market, the risk appetite. But in the meantime, the retail sales came way below expectations. So the market that was on Wednesday, the market didn't like it that much. So the month on month, that's the second month in a row that numbers are down. So you can argue on one hand that this is a big negative because expectations, it came way below the expectations. On the positive, if you look at the year-on-year, we are still talking plus 6% year-on-year, so this is not such a bad number. And if you look at the trend, you can still argue that there is some reversion to the mean to be happening. So that won't be surprising to see the US consumer, which is, remind you, making 70% of the US GDP, to be taking the brakes over the next few months and to have some reversion to the mean. So question mark is 2 months, are 2 months making a trend? That is the start of the trend, and we're going to see for further down. As always, looking at OPEX which stands for option expiry. That was yesterday. So yesterday the S&P, I'm taking the S&P, went from 3920 to almost 4,000. Why? Because the market was mostly driven by these 4,000 options. So here we get for the S&P and here we get for the SPY. So the magnet is when it starts to move, the dealers have to chase it and it goes to 4,000. So this magnet that we have been talking over and over at 4,000 is still very much here. We're going to have a reset due to this expiry yesterday. Now we can have some catalyst with the earnings and hopefully a reset on the option part. Looking at the earnings, because the earnings started 10 days ago with JP Morgan and all the banks. For this week, we had only so far 11% of the S&P 500 companies. What is interesting is 67% of them came with above earnings. So they beat the earnings by 67%, of the S&P 500 companies beat the earnings, 64% above revenues. Two interesting facts here is this is below average. Okay, below the average is roughly 70% plus. And interestingly, if you think about something that we discussed 2 or 3 weeks ago, the numbers have been lowered quite a lot for Q4 since September. So literally that was an historical downgrade of the earnings for Q4, where the numbers I think came down by 6 to 8%. And despite those numbers coming down a lot, we are not beating more than usual. And actually we are just beating, but below average. So again, this is only 10%. So this is not a sample that is big enough. but very early in the earnings season, that is not enough to move the market. And interestingly, that is confirmed by the market, which is still trading around this 39.50, 4,000. So going into next week, what's going to be important is still the earnings. We're going to have 104 S&P companies coming with releasing their Q4 earnings. So that makes roughly 1/3 of the market. So that's very significant. And I put some of the names of the S&P that are here. I'm thinking about Microsoft, Halliburton, GE, 3M. On Tuesday, we're going to have Tesla on Wednesday, Intel on Wednesday, Boeing. We're going to have Apple on Thursday, Caterpillar, which is a good indicator of the world economy. So if we are looking for the next catalyst of the next surprise or for the next surprises, that could be one of them. So far, the market, if you look at how the market has been behaving around the earnings, we are not be moving that much. Okay, so if you think about here, this is the one-day percentage change for the S&P 500 companies so far. We have been mostly moving between 2% and minus 2%. So reality is the market is not finding those new catalysts. We need to have those new surprises. Are those 33% of the overall market cap of the S&P making some changes? This is really the big question. Going forward for this week, importantly as well, as the FOMC meeting will be in Tuesday and Wednesday in 10 days, the Fed is in, or the FOMC is in the blackout period, meaning that we're not going to see Fed headlines or some Fed speakers. We could see some Fed headlines with Wall Street Journal and some other journals saying, the expectations. But normally over the next 10 days, very quiet on that part. What we're going to have is mostly earnings. Okay. What we're going to have is on Tuesday, flash PMI. So this is the early PMIs that will come a week later, and that's going to be important because you saw in the US that the numbers have been coming down and down. So we're going to see if there is a bit of confirmation. For those of you who are trading FX and are trading in Canada, the Bank of Canada on Wednesday, the expectations are for 0.25%, so 25 bips. Thursday, we get the US GDP, and here we got a big one, which is the PCE for inflation in the US. So mostly inflation. What is interesting is if you look at that chart here, both for the old securities on the sales and the earnings. So earnings will be here in orange. Earnings are not beating so far the expectations. Sales have been kind of okay over the last versus the last 4 quarters. So in other words, it seems to that there is a confirmation that earnings beat is a struggle. That's something we have been discussing in the 2023 big picture and IG generation, which is mostly due to the operating margins coming down. So going forward, we need those new surprises up, on the way down for this market to move up or down. We have been consolidating around this 4,000. If you look at the implied volatility through the VIX, it is very low versus the last 12 months at 18-20%. If you look at the SPY weekly straddle, we are at 1.7%, which is exactly the same as last week. And if you think that this week we're going to have tons of earnings, expectations are really not for a big move so far. So looking for those big catalysts, if you go and play some of those names, I don't like to be playing earnings. I think it's a fallacy when I'm listening to guys on YouTube telling you, oh, the only catalyst that I have is the earnings and this is it. It's really the casino. So there is absolutely no point doing it. And you're better off waiting for this next move to happen. My view is still the same. I think there is a good case for a bull trap where people will jump, fear of missing out and jumping, and then they will realize that actually the earnings are not good, as we have seen already, and actually that if you look at the expectations and how the economy will do in 6 months, I think this is even worse. So this is it for me today. If you get questions, if you want to join the trading community and suggest one topic for next week, that would be brilliant. And even to have, you joining and putting some comments, that will be good. If you like what you're seeing today, what you're watching, put a like, put a comment, that helps. And I see you in a week. Thank you very much for joining. Bye-bye.